House prices are completely out of control. If you can't buy a house, it's not your fault. Because the government, together with Wall Street, over the last 25 to 30 years, have been consistently destroying the housing market to the point where house prices got out of control. And the only way to get out of it is to have a massive housing crash. If you think I'm exaggerating and it sounds like a conspiracy theory, let me explain step by step what exactly is happening. So give this video a thumbs up and let's dive right into it. Back in 1980s, the median house price was around $55,000 to $60,000, while the median income was $18,000. If you adjust that to inflation, then it's around $60,000 or probably more, $58,000 to be more accurate. And over time, house prices have been consistently growing. But the only reason the price of anything would grow if there is demand for it. If people are making more money, people would be buying more houses and the price of houses would continue to grow. But if you compare the median house price historically compared to the median household income, you will see a very clear trend that over time, houses simply became too expensive while people cannot possibly afford them. Let me just give you an example. Back in 1980s, the median house price was an equivalent to 3 household incomes. That means that 3 years of household incomes would equal to a single house. Yes, houses are still expensive at that rate, but still, it is possible for most people to afford the house. You can save that money, get a mortgage, and somehow be able to afford the house. If you compare that to today, to 2025, that ratio has grown 7 to 1. 7 household income today would equal to a single house if you take the median income and the average price of the house. So what exactly has happened? If you look at these two graphs closely, you will see a very inconsistent pattern. For example, in the early 2000s, house prices have been continuously growing. However, if you compare that to median household income, incomes have been going down. In the early 2000s, the dot-com bubble burst and the entire economy is crashed. People's income began to fall, which means that people should not be able to afford the house. But suddenly, if you see it, the house prices, they've been increasing since the early of 2000s. That does not make sense because people are earning less money, which means that the demand for houses should go down, which means that house prices should not be rising this fast. Another example is after the 2008 financial crisis. You see a huge sharp in the incomes of people. However, house prices did not suffer that much and they quickly recovered. And it took much longer, for example, for incomes to go back to the exact level of the 2008. Another great example is the pandemic. In 2020, you can see a very clear pattern that the median income began to fall down because people are sitting in their homes, people are not making as much money, and a lot of people lost their jobs. On one side, stock market was growing and there were plenty of opportunities. On the other side, a lot of people were forced to not leave their houses in order to prevent the disease from spreading all across the country. That should be a very logical sign that demand for a lot of products would go down as well. And that includes houses. Houses are not cheap, houses are expensive, and nobody would risk buying a house when they don't have the money to buy that house in the first place. But if you look at house prices, suddenly you see a huge increase in the price of houses to the point that most people could not even comprehend what exactly is happening. And this inconsistency between the price of the house and the median income led to the fact that today most people cannot possibly afford the house. The median income today is around $75,000. After taxes, it is going to be around $60,000. Which means that on average, the average household is making $5,000. Now, this is not individual income. This is a household income. If you save 20% of your income, it is going to be $12,000 a year, and it will take you 35 years to save for a single house. There is no way you can save your money to buy a house. Especially by the time you're going to save your money, house prices won't just double in 35 years, they will triple. So the money that you have saved will be worth absolutely nothing. The only way for anybody to buy a house is a mortgage. So let's take the median house price today, which is $417,000. Assuming that you're a responsible buyer, you will put a 20% down payment. I mean, without that, nobody's going to give you a house or a mortgage. After a $20,000 payment and a 30-year mortgage and 7% interest rates or a mortgage rate, because mortgage rates today are between 6 to 7%, your monthly payments will total to $2,500. That means that more than half of your income is directly being paid for your mortgage in order to have a roof over your house. And if you know anything about owning a house, especially those who are watching this video, and know that owning a house isn't just about your mortgage payments. It's about renovations, it's about utility bills, it's about consistently something breaks down, and there's a lot of more cost that comes with buying a house, which means that something between 60 to 65% of your entire income would go into the house, assuming that you are going to get a mortgage and you are on the median income and you will buy the median house. If you look at individual cases in particular cities where house prices have doubled or tripled and have gone much farther than this chart that I have showed you, it is insane. It's impossible for anybody to buy a house in those places. But even if you take the average across the country, the math does not make sense. Based on this math, nobody can afford a house if we take the average Joe, if we take the average American. But if you take a look at this graph, you suddenly see a very clear pattern and you find out the answer to the questions. This is M2 money. M2 money is the amount of money that exists in the economy. But this isn't just the physical cash that exists, but all the money that exists in banks account, in savings account. And over the last 60 to 70 years, the amount of M2 money has been growing exponentially, especially if you pay attention in the early 1990s. So if you look at the M2 money pattern and you see at house prices, suddenly you see that house prices have been consistently growing alongside of M2 money. If you increase the money supply, asset prices sooner or later have to reflect the amount of money that exists in the economy. And that's why house prices have been growing exponentially. However, that doesn't mean that your income is going to reflect the M2 money. Even if the money supply is growing, that does not obligate your boss to increase your paycheck. That does not obligate your company to pay you money. But asset prices will start reflecting the amount of money that exists within the economy. And a very clear example is the 2008 financial crisis. And you see that the median income started going dramatically down. Yes, house prices for a short period of time dropped, however, they recovered very quickly. And that's because during the 2008 financial crisis, M2 money didn't just shrink, but actually it increased exponentially. So the real question is that why did we increase suddenly the amount of M2 money in the economy? What exactly has happened over the last 30 to 40 years that M2 money began to exponentially grow to the point where asset prices had to adjust, but nobody obligates businesses to raise your income alongside the increase of M2 money? At the end of the day, what drives the price of anything is demand and supply. If there is a strong demand for anything, the price of that thing is going to increase. And that's what free market is for. If everybody today would want to buy iPhones, Apple can increase their prices knowing that people are ready to pay for that. On the other side, if people are not paying or not ready to pay for anything, the price of that thing is going to go down. And that is very basic economics. So the only reason that house prices went exponentially high is for some reason, all this time, there was such a strong demand for these houses. On the other side, there is the supply side. If businesses see an opportunity that there is a strong demand for houses, don't you think that a lot of people would jump into this opportunity to build those houses, to provide those houses to the people who are ready to buy them? It makes sense, right? And that's why when you have a capitalistic economy, when you have a free market, you don't have to worry about it. Even if there is going to be a financial crisis, even if the market is going to crash, you know for a fact that the market is going to adjust itself. When on the other side, the suppliers would see that there is not a strong demand for houses, suppliers are not simply going to build those houses. So you don't have this exponential rise in prices. The problem is that when you start messing up with supply and demand, that is when you get a real problem. And that's exactly what government and Wall Street have been doing since early 1980s and 90s. Once upon a time, the government decided that they want to help the average American. It's very rare to think that politicians really want to help the average person. But how can they help them? They can't simply build houses for them. So the government decided that we will try to help the poor people to buy a house by helping them to get a much lower mortgage rate. If you can get a lower mortgage rate, you can't afford that house in the first place, but you probably make $3,000 a month, $5,000 a month. If we can bring down your mortgage rate to the level where you can buy a very expensive house with small payments every single month, we are helping you to buy that house. That sounds great. This is the plan that the government came up with. Finally, the government is thinking about the average American. Finally, somebody in Washington is thinking to help the average person to buy a house. Isn't that a noble idea? But I want to remind you of what Ronald Reagan once said. The most 9 terrifying words in the English language are, "I am from the government and I'm here to help you." If government would like to help you, trust me, they will ruin everything, because the government most likely doesn't know what exactly they do. They don't think about the consequences of their actions. And all they think about is that, what can I promise to the average person in order to get elected to the office? And what will happen after me? Nobody cares about that. What will happen after I'm out of this office? Nobody cares about that. So let me show you how exactly the government partnered with Wall Street to destroy the housing market, to make it in such a way that you no longer can afford a house. In 1968, the government passes laws where they will guarantee mortgage-backed securities. So if a financial institution such as a bank will create a mortgage-backed security, which means that they will take a lot of mortgages, compile them into one giant security and sell them to investors. And in order to ensure investors that these are very great mortgages, the government is going to guarantee them that if anything is going to happen, the government will pay back the investors. So the demand for these mortgage-backed securities will increase by investors, which is going to lower down the mortgage rates for the average American. Sounds like a brilliant plan. And it's a great plan if you think about it, because it's backed by a real asset. Every single mortgage is backed by a house that rises in value over time. So at the end of the day, the government is not taking much of a risk, because if this mortgage is going to be defaulted, then you can sell the house in the open market, pay back the investor. So the government did not see a huge risk here. Secondly, back in 1980s and early 2000s, the government starts making it much easier for anybody to get a mortgage. It's difficult to get a mortgage. You have to put a down payment. You have to be financially responsible. You have to do X, Y, and Z. Because to get a mortgage, someone else is loaning you the money, and the bank is simply the middleman. And if the bank does not see you a financially responsible person who has a stable job, who pays his bills on time, who will be able to afford this mortgage for the next 30 years, then the bank is not going to provide you with that mortgage. But what if the government is going to tell the banks, listen, just provide the mortgage and don't think about it, because you can take all of these mortgages and sell it to other investors. And we will ensure these investors that these mortgage-backed securities are safe. So when the bank is providing you with the mortgage, the bank does not have skin in the game. They don't care about this mortgage, because they will just provide the mortgage, sell it to investors, and they're out of business and they made their profit. This is how Wall Street set up their operation to take the best advantage out of the system. You have a bank that provides the mortgages. They create the mortgage and provide to somebody who wants to get that mortgage. Let's say that it's you. You head to the bank and you get your mortgage from JP Morgan or Chase or Citibank. Now, the bank will take your mortgage and will turn it into an asset, into a MBS or CDO. MBS is a mortgage-backed security. So a mortgage-backed security is simply a combination of a lot of mortgages. So if you have an investor on one side, let's say a pension fund that wants to invest in the housing market, they don't have the time or the logistics to invest in thousands of houses. So we're going to take 1,000 mortgages, turn them into one giant security, and we will sell them to this pension fund that wants to invest in the housing market. We have an insurance companies that wants to invest in the housing market. They don't have the time to establish an entirely different business, because if you have ever been in the housing market and the real estate market, you know that it's a lot of work, it's a lot of effort, and it's separately an entirely separate business. But if the bank will simply provide you with one piece of document that says that you own 10,000 mortgages based on this paper and you get the returns on them, then it's a great investment. The second type of mortgages or the second type of securities are CDOs. Now, CDOs sounds very complicated, but it's a very simple terminology. Collateralized debt obligations. When the banks realized that they can simply create mortgages and sell them to investors, they thought about how can we possibly maximize our profits? Well, it's just the mortgages that are being backed by the government. So how about we create one security? Under that one security, we are going to compile different kind of debts. So we get an auto loan, we get a personal loan, a credit card loan. Now, a personal loan or an auto loan is not being backed by the government. So it's very difficult to sell a car loan to investor because a car, first of all, depreciates over time. It loses its value. Secondly, it's not backed by the government. And thirdly, it's a very risky investment, which is extremely difficult to sell to investors. Personal loans, they are backed absolutely by nothing. Credit cards are not backed by nothing. But what if we take credit card debts, student debts probably, personal loans, auto loans, and then combine them together under one giant security with mortgages? It will turn into a collateralized debt obligation. Now, if we're going to sell it to investors, we will say to the investor that, listen, it's not just auto loan or a credit card loan, but it also consists partially of mortgages. And mortgages are being backed by the government, which means that this collateralized debt obligation is a very safe security. But investors are not stupid. Investors are very smart. They have worked super hard and they made so much money and now they want their money to work for them. That's what you do if you want to get rich and you want to stay rich, most importantly. You want your money work for you. So before throwing and investing your money, you do your analysis. You check the investment, you read everything, you analyze everything. Especially if you're a very smart and skilled investor. And you see that, there is something fishy about it. I'm not convinced. Yes, it's backed by the government to a certain extent, but I want this security to feel safe. I want this security to be a very great investment. So here's what they do. The banks take these mortgage-backed securities and collateralized debt obligations, and they would ask a credit rating agency such as Moody's or Fitch to rate them. But Moody's are not going to simply rate your securities for nothing. You have to be paid. So those banks pay Moody's and Fitch, the rating agencies, to rate these collateralized debt obligations and mortgage-backed securities. And Moody's or the rating agency look at these obligations or the securities and they will say, listen, if these securities have mortgages within them, and these mortgages are being backed by the government of the United States, then they are very safe investments. Let's give them AAAs. So they have very high ratings. Investors would look at these investments, look, they've been rated by the most respected rating agencies as AAA investments. We should actually invest in them. But banks are very smart. They're like, listen, we are going to take it one step forward and ensure to these investors that these are the safest investments that you can possibly make. And they will go to an insurance companies. Now, these insurance companies would also want to make money out of it. And they would say, listen, we are going to insure the mortgage-backed securities by providing you credit default swaps. Credit default swap sounds very complicated terminology, but it's a very simple thing that an insurance companies would say, if this mortgage will be defaulted, then we are going to cover it. That's usually what any insurance companies does. When you get your auto insurance, for example, on your car, it's the exact same thing. But the insurance company is very safe. They know that these mortgages are anyways being backed by the government of the United States. They have been given AAA ratings by the rating agencies, and they will soon be sold to the investors, so we can make a lot of money out of it, especially when they're already guaranteed by the government of the United States. So they start selling these credit default swaps to these banks, providing these insurances for all of these mortgage-backed securities and also the mortgages that are inside CDOs, the collateralized debt obligations. And finally, after taking these two securities, the banks will take them and will sell them to investors. Now, investors are everybody who has money. These are the pension funds. These are the billionaires. These are the average people. These are the millionaires. These are international investors. These are also other insurance companies. These are hedge funds. These are index funds. These are mutual funds. Any kind of investor that has a lot of money would invest in those kind of securities. First of all, these are mortgages that are backed by real assets. Secondly, they're backed by the government of the United States. Thirdly, they've been given AAA ratings by the most respected rating agencies in the world. Fourthly, they're being insured by companies. What could possibly go wrong? So everybody in the world starts buying all of these mortgage-backed securities and collateralized debt obligations. But at some point, you simply run out of money to sell these securities. I mean, you run out of people to whom you can provide the mortgages, right? Because at the end of the day, you provide the mortgages to the people who can afford them. You can't randomly provide mortgages to everybody. So Wall Street or the banks get very, very creative. And they say, listen, there are no longer people in the market who can afford these mortgages. Let's go and provide subprime mortgages. Subprime mortgages are the mortgages to people who can actually afford them. But banks don't care. What do I mean mortgages to people who can afford them? These are the people who don't have a stable income, who are not financially responsible, but most importantly, they don't even have to make any kind of down payment. These are very, very risky investments. But here's what we can do. We can take these very risky investments, combine them together with very safe investments, with good mortgages, and do the exact same thing. We're going to go to the credit rating agency. That agency, the Moody's, will look at these investments and will say, oh, half of them are actually very, very good investments that are backed by the government. So it will provide it with a AAA rating. They will go to the insurance companies, and once they have this great asset, they will sell it to the investors. But if investors start asking questions, if investors are worried that part of these assets are not safe investments, then we will simply provide them with a slightly higher return. Because if you're providing a mortgage to somebody who cannot afford it, you will charge them a very high mortgage rate. And you will use part of that high mortgage rate to pay off the investors who are asking you questions that these investments are not actually safe investments. Based on the laws that the government has passed, Wall Street has created a perfect machine for anybody in the market to buy a house. And all of this was built on the fact that the government will be guaranteeing the mortgages in the market. Basically, you have led everybody to buy a house. You have created artificial demand that started driving prices higher and higher. Because at the end of the day, if that demand is artificial, that is not being created by people who can afford houses, and now suddenly everybody can afford a house. Let me give you a very simple example. There are people who cannot afford iPhones, for example. But what if the government tomorrow will say that anybody who will buy iPhone, you can buy it and the government will pay Apple for that $1,000 iPhone? Everybody will go and buy iPhone. I don't care how much you love Android. You will go and buy an iPhone even if you don't need it. You won't just buy one iPhone. You will buy 2 iPhones. You will buy 3 iPhones. And that's what happened in the early 2000s. People like, you already have one house? Go and get another house. House prices will rise in value anyways. Oh, you don't have money for the down payment? It doesn't matter. It's a subprime mortgage. You don't have money to make your monthly payments? It doesn't matter. The bank will provide you with a mortgage. Why? Because the bank does not have skin in the game. The bank will get all of these rating agencies and will sell it to investors, believing that the government is going to guarantee these mortgages anyways. And that artificial demand led house prices to continue rising in the early 2000s, even after the early 1990s, I would say. But at some point, people realized that This is unsustainable. This system is simply pumping prices up and creating a bubble in the housing market. Everyone began selling their mortgage-backed securities and collateralized debt obligations. And when there is too much supply of these securities in the market and nobody is buying them, their prices began to fall down. The financial institutions that insured those mortgage-backed securities could not actually insure them because they did not have the money and they did not expect that the entire market is collapsed. They provided the credit default swaps assuming that the government guarantees these mortgage-backed securities and CDOs, which means that these companies also went bankrupt. The banks also collapsed, the credit rating agencies stopped making money, but most importantly, investors were furious. When everybody began to default on their loans, the 2008 financial crisis happens. And then investors start asking questions. So everybody is defaulting on their loans. What is going to happen to our mortgages? We are holding all these mortgages. And when I say investors, I mean the entire world. Didn't the government encourage people to invest in the housing market in the US so that mortgage rates will come down and people will be able to afford the house? That was the plan of the government. But now the market is crushing and investors are asking questions. Now our mortgages or our mortgage-backed securities worth nothing. Our CDOs are worth nothing. We lost a lot of money because the government guaranteed that. So what is going to happen now? The entire world, investors, Wall Street, pension funds, foreign governments, everybody just looking at the government of the United States. You promised, you guaranteed this market. What are you going to do now? The market panics. And they don't know what to do because the government doesn't even have the money to bail out the government. The government is running a deficit. I would tell you more than that. So the government looks at the Federal Reserve and says, "Dear Federal Reserve, it's time for you to save the economy of the United States." Do you think the Federal Reserve has some extra money to save the economy? Of course not. The only way that the Federal Reserve can save the economy is by printing the money and buying all of these mortgage-backed securities and collateralized debt obligations from investors to stabilize the prices. Now that's why if you look at the balance sheet of the Fed, you see that the balance sheet of the Fed exponentially grew in 2008. It tripled in a matter of a year, and after that, the Federal Reserve kept buying all of these mortgage-backed securities for years. The government should have left the market to correct itself. That demand was artificial from the people who cannot afford those houses, so the market should have crashed and the government should not have intervened to save the economy, and the market would have balanced itself. Supply and demand would determine what would be house prices. The first artificial demand was by guaranteeing them and letting people who cannot afford them to buy them. The second way to create artificial demand is by the Federal Reserve creating money out of thin air and buying those mortgage-backed securities. And that's why if you look at M2 money, it began to exponentially grow after that, even though that incomes haven't risen. And why M2 started to grow? And that's because the Federal Reserve started printing money and buying those securities in order to stabilize the market, since the government promised to back these securities no matter what happens. As of 2025, the Federal Reserve holds $2.3 trillion worth of mortgage-backed securities, and that is 26% of the total mortgage-backed securities in the market. If the Fed won't continue providing the artificial demand in the housing market, then the housing market can collapse. In fact, since 2008, the Fed has been consistently providing artificial demand to keep house prices high and high. Take an example of 2020. In 2020, the median household income went down, but because the Fed wanted to prevent what happened in 2008 and it was very worried about the housing market, it simply began providing artificial demand by lowering the mortgage rates to almost 0% by buying mortgage-backed securities from the market. So we are left with two bad options. Fed gets out of the market, that literally crushes the market, and the economy will crash alongside the housing market. Because we have seen that if the housing market crashes, everything crashes. If the Fed stays in, it will continue providing artificial demand, which means that it will keep creating money to buy those houses, which means that house prices will continue to rise. If it wasn't for the government policies of 1990s and early 2000s and the government backing or guaranteeing those mortgage-backed securities, the 2008 financial crisis wouldn't have happened and house prices would be stable. From now onwards, it doesn't seem like there is any kind of easy solution. The Federal Reserve is trying to get rid of the mortgage-backed securities, but it's very difficult and it will take the government 10 to 15 years, assuming that for the next 10 to 15 years, there is not going to be any kind of major crisis that will force the Fed again to intervene and buy those mortgage-backed securities to prevent the housing market from collapsing again, which means that we're going to have artificially low interest rates. Maybe, maybe not. I don't know. It's very difficult to predict it right now because the balance sheet of the Fed has grown exponentially to the point where nobody expected that something like this is possible. And that is why it's not always your fault that house prices are growing so much and you can't actually afford them. Because on one side, you're working super hard making more money. On the other side, the Fed keeps printing money and keeps the artificial demand to keep house prices so high. And that's why probably the only way to save yourself is to make sure that you're invested in the right assets. The only option for the vast majority of people, and I'm being totally honest, is the stock market. I can't think of a better option other than the stock market if you can't afford a house. Even if you can afford a house, maybe you can afford simply one for yourself. And then you have to get into the stock market because the stock market is not guaranteed by the government and businesses are much more careful with their investments. If there is a bad business, it will go down. If it's a good business, it will rise. And supply and demand will ensure that the market functions properly. Unlike the housing market, where supply and demand is being artificially manipulated by the government to ensure that house prices will continue to rise, and then we have such a catastrophe that is happening right now. I hope I have oversimplified everything, and I hope that it makes sense for you right now. If you've enjoyed this video, give it a thumbs up and make sure to check the links in the description of this video. Thanks for watching, and I will see you in the next one.